In the current economic situation, investing $1,000 would be the best use of your money, but where should you put it? As we know, Buffett has decades of investing wisdom. So today, we'll break down how Buffett might invest that $1,000 across different options, ensuring a balanced and diversified portfolio. We'll look at particular funds, explain why they're a good choice, and use Buffett and Charlie Munger's wisdom to back it up. Alright, let's get started. First, Buffett has often praised the S&P 500 as a cornerstone of any solid investment strategy. He's been quoted saying, "I recommend the S&P 500 index fund and have for a long time to people." Why? Because it gives you a slice of 500 of the largest companies in the United States, offering broad market exposure. So, out of your $1,000, we're allocating $700 into a low-cost S&P 500 index fund. Two great options are Fidelity's FXAIX and Vanguard's VOO. Both have incredibly low expense ratios, with FXAIX at 0.015% and VOO at 0.03%. This means that more of your money stays invested and can grow over time. Now let's talk numbers. Historically, the S&P 500 has returned about 10% annually over the long term. If you invest $700 and let it grow at this rate, in 20 years, you could potentially see that amount grow to nearly $4,700. This is the power of compound interest, something Buffett loves to highlight. By placing this investment in a Roth IRA, you could also benefit from tax-free growth, which can make the significant difference in your overall returns. Buffett's confidence in the S&P 500 isn't just based on speculation. The index comprises top companies like Apple, Microsoft, and Amazon, giants that drive the economy forward. This diversification across sectors like technology, healthcare, and consumer goods reduces risk. If one sector underperforms, others can balance it out, stabilizing your returns over time. Investing in a low-cost fund like FXAIX or VOO ensures that you're not losing money to high fees. High expenses can significantly erode your returns over time. For example, if you invest $700 in a fund with a 1% expense ratio over 30 years, you could lose thousands in potential earnings. In contrast, with FXAIX's 0.015% expense ratio, you keep more of your investment working for you. Another significant advantage of the Roth IRA is tax benefits. Contributions are made with after-tax dollars, so your investment grows tax-free. When you retire, withdrawals are also tax-free, which isn't the case with traditional IRAs or regular brokerage accounts. This can make a substantial difference in your retirement savings. Buffett's advice also highlights the importance of simplicity and consistency. He often mentions that for most people, the best investment strategy is to invest in a broad index fund and stick with it. Trying to time the market or pick individual stocks can lead to mistakes and missed opportunities. The S&P 500 offers a simple, effective way to invest in the market's overall growth without the need to constantly monitor and adjust. Regularly investing in an S&P 500 fund, especially with a Roth IRA, is a strategy that aligns with Buffett's long-term approach. He believes in buying and holding investments that will grow over time. Moreover, historical data supports his strategy. For example, if you had invested $10,000 in the S&P 500 index 50 years ago, your investment would have grown to over $1.2 million today, assuming dividends were reinvested. This highlights the potential of long-term, consistent investment in a broad market index. Now that we've laid a solid foundation with the S&P 500, let's proceed to step 2, adding small cap exposure to your portfolio. Out of your $1,000, we're allocating $150 to a small cap ETF. This strategy aligns with Warren Buffett's principle of diversification and tapping into high-growth potential areas of the market. But why small cap stocks? Small cap stocks represent smaller companies, typically with market capitalizations between $300 million and $2 billion. These companies are often in their growth phase, which means they have the potential to expand rapidly compared to larger, more established firms. Historically, small cap stocks have outperformed large cap stocks over the long term. According to data from Morningstar, small cap stocks have delivered an average annual return of about 12% over the past few decades, compared to about 10% for large cap stocks. Buffett acknowledges the potential of small cap stocks, but also raises concerns about their volatility. They can offer higher returns, but they come with higher risk. By including small cap stocks in your portfolio, you diversify your investments and tap into their growth potential. For this portion of your investment, two excellent small cap ETFs to consider are Vanguard's VBK and iShares ISCG. First, let's talk about VBK. VBK focuses on small cap growth stocks, offering exposure to companies with high growth potential. It has an expense ratio of 0.07%, which is relatively low, ensuring that most of your money stays invested. This fund covers a broad range of industries, including technology, healthcare, and consumer discretionary. ISCG is another solid choice, focusing on small cap growth companies identified by Morningstar. It has an expense ratio of 0.18%. While higher than VBK, it provides a diversified exposure to promising small cap stocks. Historically, small cap stocks have shown significant growth, despite more volatility. If you invest $150 in a small cap ETF like VBK or ISCG and it grows at an average annual rate of 12%, here's what you could expect. In 10 years, your $150 investment could grow to approximately $467. In 20 years, your investment could reach around $1,453, and in 30 years, it could potentially grow to about $4,521. These numbers highlight the growth potential of small cap stocks. While they can be more volatile in the short term, the long-term rewards can be substantial. But why does this allocation make sense? Including small cap stocks in your portfolio offers several advantages. First, it enhances diversification. While large cap stocks, like those in the S&P 500, provide stability, small cap stocks add growth potential. This balance helps manage risk and optimize returns. Second, small cap stocks often benefit from being under the radar. Larger institutional investors may overlook these stocks due to their size, allowing individual investors to capitalize on their growth potential before they become widely recognized. Buffett himself has noted the benefits of investing in smaller, lesser-known companies early in their growth trajectory. While Buffett is primarily known for his investments in large-cap, blue-chip companies, he has occasionally ventured into smaller companies when he sees growth potential. His investment philosophy emphasizes understanding the business, its growth potential, and its management. This approach applies to small-cap stocks as well. Buffett advises investors to focus on companies with strong fundamentals, even if they are smaller and less well-known. As with any investment, it's essential that you monitor and periodically rebalance your portfolio. Small cap stocks can be more volatile, so their value within your portfolio may fluctuate more dramatically than large cap stocks. Rebalancing ensures you maintain your desired allocation and manage risk effectively. Moving on to step 3, let's focus on investing $150 in a value stock ETF. This approach, inspired by Warren Buffett's investing principles, adds another dimension of stability and growth to your portfolio. Value stocks represent companies that are undervalued by the market relative to their fundamental worth. These companies typically have strong earnings, dividends, and cash flow, but their stock prices don't fully reflect these strengths. The goal of value stock investing is to locate deals or businesses that are valued less than what they truly are. As a follower of Benjamin Graham, Warren Buffett has consistently promoted value investing. Buffett famously said, "Price is what you pay, value is what you get," emphasizing that the intrinsic value of a solid company remains constant even if its stock price fluctuates. For value investing, Vanguard's VTV is an excellent choice. VTV targets large-cap value stocks and has a low expense ratio of 0.04%, making it a cost-effective way to gain exposure to high-quality value stocks. This ETF includes companies with strong fundamentals trading at lower prices relative to their earnings, dividends, and growth potential. Value stocks have delivered solid returns over time, particularly during market recoveries and economic expansions. Here's a projection of your $150 investment in VTV. 10 years. Assuming an average annual return of 10%, your $150 could grow to approximately $389. Within 20 years, with that same return rate, your investment might reach around $1,008. In over 30 years, this longer period allows your $150 to potentially grow to about $2,615. Because of their solid fundamentals and compounding ability, value stocks have a significant growth potential, as the projections demonstrate. Adding value stocks to your portfolio offers multiple benefits. First, value stocks often provide dividends, generating a steady income stream that can be reinvested to enhance returns. Secondly, value stocks tend to perform well during economic recoveries and stable market periods, balancing the higher volatility of small cap stocks. Buffett's investment strategy has always emphasized value. He seeks companies with strong earnings potential, competent management, and a substantial margin of safety. By investing in a value ETF like VTV, you adhere to these timeless principles. Buffett's approach to value investing focuses on identifying high-quality companies that are temporarily undervalued by the market. He prioritizes businesses with a durable competitive advantage, strong management, and consistent earnings growth potential. This long-term perspective allows investors to benefit from market corrections and the eventual realization of a company's intrinsic value. Buffett's investments in companies like Coca-Cola and American Express reflect his value investing philosophy. He purchased these stocks when they were undervalued, confident in their ability to generate strong returns over time. This approach has been central to his success and serves as a guiding principle for investors looking to emulate his strategy. By regularly reviewing and adjusting your allocations, you can maintain a balanced and diversified portfolio that captures the benefits of value investing. Another angle to consider is how value stocks perform in different market cycles. During economic downturns, value stocks often outperform growth stocks because they are already trading at lower valuations, and their stable earnings and dividends provide a cushion against market volatility. This defensive characteristic makes them a valuable addition to your portfolio, especially in uncertain times. Let's look at a real-world example to illustrate the power of value investing. During the 2008 financial crisis, value stocks, particularly those in the consumer staples and healthcare sectors, showed resilience compared to their growth counterparts. Investors who held value stocks during this period experienced less severe losses and quicker recoveries, demonstrating the protective quality of these investments. Understanding behavioral finance can also enhance your value investing strategy. Investors often overreact to short-term market news, leading to the undervaluation of certain stocks. By maintaining a value-focused approach, you can take advantage of these market inefficiencies. Buffett has said many times that it is important to be fearful when others are greedy and greedy when others are fearful. This shows how a value investor can make money when the market is not acting logically. Combined with your investments in the S&P 500 and small cap ETFs, you now have a well-rounded portfolio designed for long-term success. But wait, if you want to know more options for investing your money, check out this video to find out the best AI ETFs that you should buy and hold forever.